It's time to get started. I'd like to introduce myself very briefly. My name is Peter Cummings. I'm the Associate Dean for Research here at the Engineering School and also a faculty member in the Chemical Engineering Department. It's my pleasure today to introduce our Spring 2018 Chambers Family Entrepreneurship Lecturer, Bruce Evans, who's Senior Advisor and Chairman of Summit Partners, and he's also Chairman of the Vanderbilt University Board of Trust. I'll just say a few words about the Chambers Lecture and about the Engineering School. Entrepreneurship is very important in the School of Engineering. We have a very strong commitment to entrepreneurship, coupled to education and research. We have exceptionally strong research programs, for example, in surgery and medicine that generate a lot of innovation in our engineering school. We have a large institutional commitment to long-distance learning. We have some of the largest MOOCs in the country in the area of software engineering for innovation on mobile devices. We have companies being spun off by faculty and students, and also our undergraduate students who are especially entrepreneurial at Vanderbilt. Our undergraduate capstone design products are sponsored by companies. Many of them are sponsored by companies and result in significant innovations. And as we're sitting in this building here, which houses the Wondery, that's another evidence of the commitment of the university to the entrepreneurial spirit of our undergraduate and graduate students. The Chambers Family Entrepreneurial Lecture Series, this is the 8th such lecture. It's a lectureship endowed by the Chambers Family Medical Foundation, and the Chambers family has a long association with Vanderbilt going back 3 generations. George Russell Chambers, a 1940 graduate of the Engineering School. His son, Carl Russell Chambers, who was a physician and philanthropist, and Russell founded the Chambers Medical Foundation, and also the Russell Chambers Scholarship, which is awarded to engineering students. And then Jason Chambers, Russell's son, and a 1999 graduate of the Engineering School, is specifically responsible for getting this lectureship endowed. He's a very strong promoter of entrepreneurship and innovation as a member of the Vanderbilt University School of Engineering Board of Visitors. And then Bruce Evans. Bruce is also an engineer. He received his Bachelor of Engineering degree in Mechanical Engineering and Economics from Vanderbilt in 1981, and then an MBA from the Vanderbilt of the North, Harvard University, in 1986. He then joined Summit Partners in 1986, just 2 years after its founding. Summit Partners is a growth equity, venture capital, and credit investment firm, which has raised approximately $16 billion in capital since its inception. He's served on the board of directors of more than 30 companies, and he's formerly served as a member of the National Venture Capital Association Board of Directors. He has very significant service to Vanderbilt. He was elected to the Board of Trust in 2009, serving as chairman of the investment committee and as a member of the executive committee. And then in 2016, he was elected as chair of the Board of Trust effective July 1st of 2017. He also serves on the Board of Governors of the Vanderbilt University Medical Center. So it's a really great pleasure to introduce an alumnus of the Engineering School who's going to talk to us today about his experience in the venture capital arena, and we look forward to hearing your talk very much, Bruce. Thank you.
Thanks, Peter.
Over to you.
All right. Let's see if that goes. No. Pardon the technical interruption.
Oh.
There we go. There we go. So, ready to start. So So again, I'm Bruce Evans. I've been around Nashville at Vanderbilt since 1977 with a few interludes elsewhere. But my objective today is to talk about the fundraising process from the perspective of a venture capitalist, which I'm told is somewhat different than what has happened in prior Chambers lectures. And oh, no, it was already on, I thought. Pardon me. There we go. How's that? Perfect. We'll perfect this yet. But anyhow, so my objective is to talk about fundraising from a venture capitalist perspective in order to give you that view of the world as opposed to the one I know that those of you who have attended these in the past have seen, which is the view from an entrepreneur. I'm sort of, what I've done is I've learned how to be an entrepreneur by watching other entrepreneurs, and so I can report on their side of the equation as well too. So occasionally I'll slip into that mode, but. What I thought I'd do would be to just say just a few more words about how I got into the venture capital business. Talk a little bit of preliminaries. I had been told there'd be a wide range of people at this, and so some of the preliminary items are targeted more at the undergraduates, and then we'll move into some things that are specific to fundraising. And I have a lot to say. I can spend much more time than I have. And by the way, I have until the top of the hour. Is that when I? Okay. Yeah. Yeah. Okay. All right. So, it didn't come through. There we go. Didn't know it did all that. So my background, before I came to Vanderbilt, I went to high school in West Virginia. I came to Vanderbilt on a scholarship, an academic scholarship to the engineering school, and I would say that is one of the drivers behind my desire to get involved with Vanderbilt after graduation. I kind of felt like Vanderbilt had done a lot to help me get started, and I wanted to do some things to give back to the school. And so when I was here, I came into the engineering school, and I pretty quickly discovered that the part of engineering that I liked was the part that helped with problem solving and thought processes and a lot of the creativity that comes with the education, but that I was more interested in combining that in some way with business than I was in just becoming a core technologist, engineer, which was certainly a good choice, but it wasn't the choice that was right for me. So when I got out, I went to work in sales for IBM, and I sold mainframe computers in Louisville, Kentucky, and I did that for 3 years. My big account was Kentucky Fried Chicken. It was a good count, good place to learn, and I did that for 3 years. And I sold the really big stuff. It was like a systems sale, which actually was helpful to me later in my career, because a lot of what a venture capitalist has to do is a systems sale in the same way that selling a big mainframe computer used to be back in the 80s. But I went from IBM to Harvard Business School. I kind of figured it was a good way to transition into a thing that was a combination of technology and business. And I ended up stumbling into Summit Partners, which had been formed about 15 months earlier, when I got there in 1986. And one of the reasons that they hired me was that the guy that ran the firm was from Macon, Georgia. He was looking for another guy that was nominally a Southerner, and he hired me for that reason. And so I stayed for 32 years. In 1999, the guy that hired me decided to retire, and so a couple of my partners and I did a leverage buyout and bought the business and ran the business for 18 years. And actually, as of January 1st, we worked out a deal where with the next generation of people in my business to take it forward, to give those from my old generation the ability to do other things. So my preliminary ideas, and I think some of this is targeted at at undergrads, and maybe people that have engineering training and are looking to think about how they might get into business, but haven't had much business training. And again, the topic at hand is how do you raise money for an entrepreneurial venture, and I think the first thing you should do is just make sure you develop some financial literacy. Know how to read an income statement, a balance sheet, a cash flow statement, because that's the way to scorekeep when you're in the business world. And the people that you will encounter, that you will raise money from, will talk in this language, and you want to be able to know what they're talking about and make judgments about what they tell you, and actually make good judgments about what you're going to tell them. The other piece that I'm going to assume is that as we work through the decision process about how we fundraise, that the type of fundraising your entrepreneurial venture or the thing that you would be interested in doing would be more in the area of venture capital, because the way you can describe the industry, it's a form of an alternative investment industry that's focused on providing private capital to companies. And the notable thing about these types of investments is they don't trade on the public markets. You buy equity in a company just like you would buy stock in a public company, but once you buy it, you can't really sell it unless you go find somebody privately to sell it to. And so they call the whole industry private equity, and they also call the other thing that there's sort of a naming problems. The part of the industry that's fundamentally a leverage buyout business, where you think about using debt and a small amount of equity to buy a business, is also called private equity, and it's also called the leverage buyout business. But the side that I'm thinking about and preparing to talk about is the venture capital side, which is you got a small company, you have to finance that small company, and there's some risks involved in that financing, and some of those companies fail, and this is really risk capital for that type of opportunity. For emerging growth companies is the way to think about it. So a little bit more background on venture capital firms, just to talk about the structure. So the way the business works, the way a venture capital firm works, is every couple of years it raises money in a pool. So I took the little red squares here are around all of Summit Partners venture capital fund fundraisings that occurred from 1984 until 2016. And so you can see a pattern where every 3, 4, 5 years we would go out and we'd raise a new pool of capital. And what would happen was we would raise that pool of capital, and we would target. We're a money manager in the same way that a mutual fund money manager might be in the context of Fidelity Investments. You know, you have somebody that buys tech stocks, you have somebody that buys large cap stocks, you have somebody that buys dividend stocks, and they manage a pool of capital that has a strategy. Well, venture capital firms have strategies too. And an angel investor manages a small pool of either his or her own money or investors' money and makes very, very early stage investments. An early stage venture investor takes a thing that's a little bit beyond an idea, where there's a small team that's been formed, there's the basis for a product, and funds it with more money and takes it to a point where a product can hit the market. A late stage venture investor might have a company that has revenues and has reached profitability or is close to profitability or has a line of sight on profitability and invests there. And then a growth investor does the very last stages of investing before a company goes public. And then once you get to the IPO market, then you're tapping a capital source that's not private, that trades publicly, and where if you buy a piece of equity, you can sell it to somebody pretty easily in the public markets. Another way a strategy can be set up is based on sector. You could be a technology specialist or a healthcare specialist, or a focus on any number of other things. Geography is a thing that people often pick. But the one thing about the venture business is that right now there's a fair amount of money in it. And so if you have a good idea, and if you target your effort with your company or with your idea to find a venture firm that has a strategy that matches with that company's objectives or your business idea, you can get financing in today's market. There was $84 billion invested last year. There was similar amounts that had been raised over the last several years. And so anyhow, there's money out there, and then you can raise it if you've got a good idea. So what I always do when I think about a company from an entrepreneur's perspective is I kind of cut it into four parts. And some of these things, the ones that what you care about the most is a function of the stage of your company. If you have an idea, if you're starting with an idea, you've probably started from the perspective of the market first. What's the market I want to address? How big is it? How fast does it grow? What can I do to serve it? And then having taken a look at the market, you can then develop a product or service that might fit the needs of that market. Now, most people don't just start with a clean sheet of paper and do those things. They come with some experience, maybe even a lot of experience, and they have qualifications that would give an indication that their ideas are good, and they're based on past success and maybe even past failures, but they're based on something that would cause them to have the credibility to be able to go out and create a company around a product or service that fits well with the market. This last bit about the historical and projected financial performance, this fourth thing that you would look at, is easier if you actually have financial performance to look at. And if you don't, then you don't have to make it up, but you have to do some work to try and project it and present it and think about the business model that you're trying to create. But to me, the key things are think about your business as though it has those four parts, because those are the key components that you'll work with as you build and create. The other thing that you have to do when you're at the stage of beginning to consider a fundraising is to make an honest assessment of each of those parts of your business. And when I say honest, I mean be intellectually honest. Try to make a judgment that's just about the way things are, as opposed to the way you wish they were. Once you've made this assessment of your business, the next thing you want to do is you want to think about, okay, I've got this business. This is the stage that it's in. This is the opportunity I have. How am I going to raise the money I need in order to meet my objectives? And there's three ways to do it. You can make it, you can borrow it, or you can raise it. And if you got a business that produces cash relatively early on, you need a whole lot less to get started than if it's a very capital intensive business. And the characteristics of your business will drive you in a particular direction. If you borrow money, you don't have to give up equity. You don't have to take dilution when you borrow that money. But at the same time that you borrow money, you, generally speaking, take on financial risk, because debt wants to be paid back. It wants to be paid along the way. And if you don't pay it along the way or pay it back, then oftentimes you lose your business. And sometimes you're required to guarantee things personally, and you could lose some of your personal assets in conjunction with doing what the debt wants you to do. With equity, you've got a lot more flexibility. You've got big pools of capital. But the issue with equity is you can only sell it once. And so you could try to sell it more than once, but that wouldn't be a good thing to do. But you can only sell it once, and so you have to be careful about the way you proceed when it comes to raising equity. I will assume, for the purposes of this talk, however, that we have decided, having assessed our business and having considered our sources and methods of raising capital, that the conclusion that we reached was that we wanted to raise equity. And so the first steps in a fundraising process, after you assess your business and determine your capital need, the next thing you want to do is you want to make sure you're ready to start on your fundraising. And one of the key parts of starting with a fundraising is to having the data and the information at hand and organized in a way that an investor could look at it and take action, and reach conclusions, and after review of that information, and want to take action. Because one thing that happens sometimes is people get really anxious to get going on a fundraising, but they don't have their financial statements in good order. They don't have their intellectual property tidied up in a way that they can prove that they own it. They have 3 of their uncles on the team, and things that they do that when they get to the time where they're in front of an investor, the investor says, either please give me this information, or why do you have so many uncles on your team, and that gets in their way. And so get ready to fundraise before you actually start. The other thing is you want to organize the advice that you think that you're going to need. And not every situation calls for an investment banker or an intermediary to help you. I would say that a lot of what you want to do with respect to getting an investment banker or an intermediary to help you with your fundraising is a function of the size and stage of your business. The more money you want to raise, the larger your business is, the more valuable it is, the more likely it is that you want to hire an intermediary. The earlier stage it is, if it's pre-revenue, you're probably not going to be able to interest anybody in helping you unless you have significant prior experience and success as an entrepreneur. And so in that case, you'll just have to do it yourself. I think the most important person in a fundraising for everybody, however, is an experienced securities lawyer. You don't want to have your lawyer that handles your estate or just did your real estate closing do this for you. It's a specialty, and so you generally speaking would benefit from getting the advice of a lawyer who is familiar with transactions of this type, and not any securities lawyer, but somebody that's familiar with venture capital transactions, because there's a lot of market knowledge that person has gained, and a lot of market norms that are useful in negotiations that person will know about, that'll help you get things done. The other thing I think you want to do is you want to identify multiple fundraising sources. As opposed to going to your best friend, the venture capitalist, go to more than one, because you will benefit from a competitive situation. Even if it's your friend will get more excited to become your investor if your friend knows that you've got 2 other friends and they all want to be your investor too. And so my next thing would be identify sources. And in part, the process of identifying fundraising sources requires you to try and match your objectives with the strategies of the potential investors. Because if you go to a potential investor with a $2 million deal and their minimum deal is $50 million, you're not going to get their attention. If you go to a healthcare investor with a semiconductor device company, you're not going to get their attention. And if you have a mismatch on the stage of your business relative to where this firm invests, they'll turn you down too. And so find firms and find individuals who are looking to invest in the kind of thing that you do. And then the final thing is prepare your fundraising pitch. And I say pitch because you have to be a salesman in this process. You have to present your business or your business idea in an accurate way, but you've got to present it in a way that it's appealing. And you almost have to think about how you would develop an investment thesis for your potential investor that they could look at and say, wow, that's a good investment thesis. I think I'll adopt that one as my own. And that's kind of what you want to do when it comes to your fundraising pitch. And part of that process is you got to go approach a number of investors, tell them some stories, and justify your objectives, and convince them that they want to be your partner. And if you do that, what will happen is the ones that engage will start to think about your business as having 5 parts, and you'll start to have to think about this 5th part too. You could have the world's most wonderful business, but if you have expectations that are at odds with what the venture capitalist cares about, which is that it fits with their strategy, that the size investment and the valuation of the investment looks realistic, that there's a probability of a successful negotiation, and that the risks and rewards are in balance, then what will happen is that the venture capital will try and dig into those other 4 things and just make sure that what you've said is what they think too. But this number 5 is important because, I've been in lots of situations where I see a company that I think is terrific, run by an entrepreneur that I think is incredible, but the price is wrong. And I've been in other situations where I see great entrepreneur, great situation, great price, but I don't think I can win. And so in instances like that, I move on, because one of the things that venture capitalists always say is that they've got more money than time. And so they're very interested in finding opportunities that meet their objectives on the one hand, and that don't waste their time in the process that it takes to get a deal closed, because it usually takes 4 to 6 months from the first day you meet somebody until the day you finally invest in a situation, and it can take longer than that. And so there's an intensive, there's a time risk that for a venture capitalist is not as bad as a money risk or a money loss, but you don't want to. If you keep losing time, you don't get anything done, and then pretty soon you find that you're not in the business anymore. So let me just say this, my note on investment valuation terminology. Many of you may know this, and this is just a simple form, but people talk about pre-money valuation. What that means is that's what your business is worth before the venture capitalist invests in it. Then you add the money that they invest, and you get to a thing called a post-money valuation. And the venture capitalist has purchased from you a percentage of the company that equals the money they invest divided by the post-money valuation. This calculation could get complicated, but the way a venture capitalist makes money is they make money by multiplying with you, doing the hard work and them giving the help, by multiplying the value of the post-money value of your business. So if I make an investment in a company at a post-money value of $50 million, and then we work together and sell it for $150 million, that's 3 times, in effect, 3 times my money as a venture capital investor. And so I'm always working off the post-money valuation. There are things that affect that valuation. As I said, that's a simple form. There's lots of different things that can affect that calculation and affect the way that you would view a valuation. And I would say the 2 main components of that effect would be, does all the money stay in the company, or does some of the money go into somebody's pocket? That can have an effect on the post-money valuation. I didn't do that calculation, but that can be a calculation that can affect valuations. And then the other one is, what are the terms of the security? If I'm an investor, I would much rather own convertible debt because it pays me interest, it's senior on the balance sheet, and I can convert it into common equity if the company grows, and I can be better off and protected. if I own that security. So I'm generally willing to pay more for that security than I am for a thing called a convertible preferred stock, which is a more senior form of equity. And I'm willing to pay more for a convertible preferred stock than I am for common stock. And so all those things can affect your view, my view of valuation. They're part of the negotiation, and it's a reason to have an experienced securities lawyer help you assess what has been presented to you from the point of view of an offer. This is just a little note on convertible preferred stocks. The key point about convertible preferred stocks, actually there's two. One is it is the most common form of investment of a security that a venture capital investor will buy, is a convertible preferred stock. And the second part about a convertible preferred stock is it behaves in one way when things go well. It behaves just like common stock. And when things go poorly, it behaves more like a debt instrument. It's not a perfect debt instrument because it's junior to the debt, but it behaves in a way that acts like a stop loss for the investor. And so if you can see some of my math, but you know, the key points are around the little green box at depending upon where the pre-money, I'm sorry, the post-money equity valuation at which I invested. That's four different examples, but depending upon the price that I paid for the company when I invested, and depending upon the price I sell the business for, I would either convert or redeem based on the relationship between those two. And when I say convert, I mean convert into common equity, and when I say redeem, I mean give me my original money back. And this security is one. You can study that. I don't want to go into it in great detail because it takes a while to explain. But this is a security that you should just get to know and try and understand better if you're in a fundraising process. It doesn't provide as much. It doesn't matter quite as much if you have a heavily levered business because there's not a lot of protective value in a preferred stock. It doesn't matter as much if it's a very, very early stage investment because a lot of early stage investments don't work and everybody loses their money, including the preferred stock. But it can have an impact if in situations where a company is up and running and there's and the investment return is a question more about what's the valuation you can achieve at the end than it is the success or failure of the business. So the final step in fundraising is hopefully you get some investment offers. Hopefully they're in line with your expectations. If they're not, you've got a judgment to make. Do I go forward? Do I finance the business another way? Do I fold up shop? Or do I just make the best of what I've got? But let's assume you get an offer you like. I think what you do, and hopefully you get multiple offers. You negotiate a deal with your preferred partner, and generally speaking, you try to negotiate a letter of intent that describes the general aspects of the deal, gives you enough to then be able to work with a lawyer to write it all down in the form of a definitive agreement. The other thing that will happen as you're trying to put the legal agreements together is the venture capitalists will be working on finishing their due diligence, and they usually have somebody that they report to that's behind the curtain who they need to get the approval from. And so they'll be working real hard to work with you to prove out their investment thesis. They'll try to get the information they need in order to be able to do that. They'll go back to their office and they'll present to a group back in their office, and they'll get beat up and they'll have to go get more information from you, and they'll come back and do it again, and eventually, hopefully, they'll get to a place where they have the approval to make their investment, and you've got the agreements to a place where you can finish and consummate those agreements. And if everybody comes together in a way that they have the approval, you've got the agreements in a satisfactory stage, you can close your investment, and your company has the money. Now, this last page this is actually a bigger deal, because once you have the money and the resources to be able to pursue the objectives that you've set out, then then that's when the real fun begins, the work begins, the excitement begins. It was the part of the business that I liked the best, was to work with the entrepreneurs that I met along the way. It wasn't a negotiation anymore. It became a cooperative thing. It became a situation where we had a common objective that we wanted to achieve, and we worked together to do that. And where I would generally get involved as a venture investor, and where I would say most of you would encounter venture capitalists, would be as a board member at your company. And there are all kinds of different behaviors for all kinds of, for both management teams and for venture investor board members. But I think my own point of view was that I backed a company and I backed an entrepreneur because I believed in that person. I thought that they had the product market expertise that was needed for the objective, and I wanted them to run the company, and I wanted to give them some help. And one of the things you'll have is sometimes you'll have people that were in the role as a venture capitalist, and they think, well, I know more about the products and markets than the people I've backed, and they start to try and run the company and do things that get in the way. And the way I always thought about it is if I knew more about the products and markets than the person I was backing, then maybe I should have been the CEO and I shouldn't have backed them. And so I think that the best relationship is one that respects the fact that you are the CEO, you are the management team, and your investor is there to help but isn't there to run your business. And I think that's the way you ought to make judgments about people. And one way you can make a judgment about a venture investor before you close is call their references. And you can talk to people they've worked with, and you can get an indication of how they work, and you'll be able to make some judgments that'll be important judgments. But you should expect that your venture capital partner is going to have probably 5 to 7 years of patience. And the reason they have a time limit on their patience is their pool of capital is time limited too. And most of those funds that I showed you that Summit Partners raised were 10-year funds. Our investors, which were pension funds and banks and insurance companies and other and wealthy individuals and institutional investors generally, gave us the money, and they wanted it back. And the sooner the better, and the more the better. But they said, you've got some time to go do what you're doing, and generally speaking, that time was 10 years. And so you can go work for a good long time with a company, but eventually you have to have a conversation with a CEO that says, hey, I've got to find a path to an exit, a path to some liquidity. Will you help me? And I'd say for the most part, entrepreneurs are sympathetic to that. Sometimes they're not. If you're a venture capitalist, you have to care about that, and you have to care about the performance of your investments, because really what happens in the venture capital cycle is you raise the money. It takes you 4 to 5 years to invest it. You have to show some progress in those 4 to 5 years. You have to show some returns, some trajectory on your fund. Then you're out of money, so you got to raise another fund. But you don't have the first fund done yet. You're still working with the companies that you've invested in, and the cycle repeats itself. And by the time you get to the third fund, that first fund better be relatively liquid. And you better be able to demonstrate that you generated an IRR that was compared favorably to your peers, to like funds of the same vintage year, to the public markets, because a lot of times what investors will say is, we want your money's private. We need a premium for illiquidity. And so you need to deliver us 300 to 500 basis points better than what the public markets delivered in that period of time. And so there's lots of different ways that you get compared as an investor. And if you don't give the money back and create a multiple of what was given to you, and if you don't do it in a timely fashion that creates an IRR that's favorable, you don't get any more money and you're out of business. And so one thing you know about a venture investor is they're investors, they're judged on their performance, and they will act that way when they deal with you. And to the extent you help them, great. And to the extent you don't help them, then they have to figure out what to do. and so that's their actions are predictable. But anyhow, I think I won't go through this last thing because I want to have some time for questions and answers. The only thing this week, I don't know if this will be posted somewhere or available, but the thing that I will tell you is that most venture investors, if they raise a $100 million fund, which is that green line, have an objective of returning somewhere between 3 and 4 times what was given to them. Because when you take a look at the fees, which are the red lines, the fees have an effect on what nets out to the investors. And so, but in order to produce the kind of IRR that you need to produce in a 10-year fund, you got to make 3 times or more your money in order to overcome the fees. Give your investors 2.5 times at a minimum what they gave to you, and make the kind of IRR you want. So when you make an investment, you want to think about a company as having the potential to generate 3 or more times what you invested in it over the life of that investment. So you do need some significant growth, and you also, as an investor, need to realize, depending upon your strategy, that you'll have some losses, and you have to overcome those with some that do 5 or 10 times your money. And it's an interesting business that can be reduced to fund math, but in each individual case, the investor is just working hard with you to make your business more valuable than it started, and hopefully that's what happens to all of you. But anyhow, that's all I have. That's all I have on this topic. I don't know if there are any questions. This is a cartoon that I cut out in 1999 that's been on my desk ever since, but it was right in the middle of the internet bubble, which was an interesting time to live through as a venture capitalist. But any questions? Yes.
I'm Dr. Wilson Bell. I'm also an engineering alumni and a startup co-founder. I had a question about the investment thesis. And you said something that was really, really powerful, how a startup founder can go to a venture capitalist with their own investment thesis and somehow convince the venture capitalist to make their thesis their thesis. Can you tell us more about what that takes or what's involved in that?
Well, if you think about your business as having the first 4 parts, product, market, people, and historical and projected financial performance, and then you layer in what's the deal going to look like, you can reduce that into some words that become a more or less succinct statement of the opportunity. And venture capitalists see a lot of different things. And if you have your business reduced to a succinct statement of the opportunity, it makes it easier for them as they're scanning the horizon for the next deal to stop on yours. And then once they get to know you, then you can develop it further and put some more words around it. And it's sort of, I don't know, I've with the press always likes it if in my experience, if you can help them come up with their storyline. And this is the same thing, except it's a venture capitalist and it involves money and it involves a long-term commitment, but the way you get them started is to say, hey, this market's growing very fast, my product meets the need in this way, I have these great experiences as an entrepreneur, and look at this wonderful business model, and oh, by the way, the deal is really cheap. And so you kind of help them out in that way. You want to do it in a way that when you say it up front, you can prove it later when they dig in on the due diligence. But that's the way you do it. Any other questions? Yeah.
Yeah, my name is Thomas Love. I'm an undergraduate. I was just wondering about, you talked a lot about the fund, the investment thesis, the raising equity. The question is about a lot of the terms that you were looking at, like the different contracts, the options, the warrants, all these different parts. But when you mentioned a little bit about the dilution, so certain equity pool, they can get wiped out, right? I mean, when like if a company is bought and sold, then the previous investors are going to get wiped out. Is that something that happens in this early stage?
Well,
it's a lot, or is that just based on you can only sell the equity once, so watch out who you sell it to? I mean, is that?
Well, if you have 100, if you found a company and you have 100 shares and you sell me 40,
Yeah.
you own 60 and I own 40. You just took dilution because you used to own 100% of the company. Now you only own 60. So that's one form of dilution. There's another form of dilution where you raise some venture capital, and I own 40, you own 60, and your company is losing money, and it runs through all the capital you've raised, and you've got to raise money again. And if you own 60, I own 40. If I put up 40% of the money, I maintain my ownership, and which means you have to put up 60. But if you don't have the 60, I can put up my 40, and I can put up another little bit, and I can dilute you much more heavily. And so there is a concept where if you don't put up money in a later round, as a company is growing through stages, you can be diluted heavily by that lack of ability to put new money up. That happens to you most often when your company is in, let's say, a negative situation. Because if you're in a positive situation, it's very easy for you to raise money again in the next round from somebody else, not just your current investment partner. But if you're in a company that's struggling, you may not be able to do that, and you may find that you need to protect yourself by putting up that next round. I would say it happens less often to entrepreneurs and more often between venture capitalists, because if venture capitalist A is in there and owns 20%, and B owns 20%, and the entrepreneur owns 60%, and there's a new round, and one of the A or the B doesn't put money up, they might get very, very heavily diluted by virtue of not putting up new money. And the entrepreneur, if that entrepreneur is needed to take things forward, doesn't get completely protected, but gets protected to some extent. A venture capitalist without money in a situation where a company needs money is not of much use. And so they can sometimes find themselves in a bad spot. But there's lots of different ways that if you're an investor, you can protect yourself against that. There are ways that if you're an entrepreneur, you can make yourself useful and protect yourself against that. But those things, that does happen. But dilution, the topic of dilution is a reduction in your ownership interest in a business. And so sometimes dilution happens in an affirmative way because you've sold intentionally a piece of that business, and sometimes it happens because you can't protect yourself.
Can I ask you for a quick gut check on two very different topics, but just quickly. One, some people say, particularly in the tech startup area, everybody suffers by the relative scarcity of new IPOs and things like comparables, that we need more comps. And then the other is, do you think that things like initial coin offerings are a significant factor in terms of disintermediating VCs or anything else?
Okay, second one first. I don't think much of initial coin offerings. My own opinion is that a lot of these cryptocurrencies that exist today will not exist in the future. The thing that will exist is the blockchain technology that will be used to assure transactions, but I don't have much faith in the concept of an initial coin offering replacing anything. It's also been lightly or unregulated, and increasingly the SEC is going to look at it and regulate it in ways that that I don't know where it leads. So I'm going to take that one and not worry about it. In terms of the IPO markets, the problem with the IPO markets is it really can be traced back to the Sarbanes-Oxley law back in the early 2000s, to a lesser extent to the Dodd-Frank rules, but the Sarbanes-Oxley rules that were put in place in the early 2000s just made it difficult to get public. It just threw a bunch of overhead on public companies, and it also changed some things, changed the incentives for investment banks in a way that they cared less about smaller companies. And then there was also the reaction, which was, I think, a reaction that was warranted from a period of time that we went through in the late 90s and the early 2000s that related to the internet bubble, causing investors to be wary of less mature companies. But all those things together, but particularly the Sarbanes-Oxley laws, resulted in fewer IPOs and resulted in larger private markets and made the importance of venture capital funding, growth, private growth funding, rise in importance. I think the IPO markets are right for companies, right for tech companies. But those tech companies need to be multi-hundred-million-dollar companies really today in order to be able to tap those markets where they could be sub-$100 million, 15 years ago. And I think what it does is I think the lack of availability of an easy way for emerging growth companies to get public just takes capital away from growth, takes capital away from emerging growth companies, and just isn't helpful to the economy in general. But the counter to that is that private sources have moved in to fill that void. And I don't know if you saw if you remember my firm's, the funds that we raised grew in size over time. And one of the reasons they grew in size is they grew in size to meet the need of private companies that used to be met by the public markets. And so there's still money for growth, there's still money for emerging growth companies. You can get through to being a public company. You just have to be a whole lot bigger. I think the other thing it does is it advantages the larger, more established companies that already have access to public capital, because public capital is cheaper and can be obtained in higher quantities. And it's, that's why Oracle and Microsoft and some of the large public companies are as large as they are and as acquisitive as they are, is that they're a way for venture capitalists to be able to exit that they need to do, that they used to do by taking companies public. Philippe?
Bruce, there are really many students and faculty here, and I think many of them either have started their business or are thinking about it. And so first-timers make mistakes, right? So from your point of view, what are the big pitfalls? What are the big mistakes that a first-timer may make so that you may not even consider them as somebody you want to support?
I mean, there are a lot of different ways to make mistakes, I will say. I just, there's so many ways to make mistakes, but...
What about the top three?
Well, I think that, what I usually see is I see a mismatch between the market opportunity and the effort required to go get that market opportunity. And first-timers, particularly technologists, tend to develop products that are really neat, incredible inventions, but that are targeted at a $20 million market, or a market that's just never going to grow. And just, it's a great idea, but it's not a great market opportunity. That's one thing. I would say the second thing, and again, since just from an engineer's point of view, from a technologist's point of view, the other thing that I see a lot is a failure to consider and properly control the nuts and bolts of the business. So you got a great idea, there's a great market opportunity, but money is squandered needlessly just because the proper controls weren't in place, the discipline on the management side wasn't there to control the expense, and that would be a second one. And then I'd say a third one, you know, probably boils down to kind of the human aspect, you know, hubris and inflated egos and things that you sometimes encounter with people. The people part is the tricky bit. It's the part that actually that when you've been doing what I do for, you know, a long time, I think you have to become good at it or you don't survive. As you can make judgments about people, you know, in business contexts that are pretty good. But people that are new, that are first timers, don't quite have the same frame of reference when it comes time to hire a vice president of sales or to make a judgment about an investor. And it's you know, it's a reason to have an advisor. It's a reason to have experienced advisors to whisper in your ear, and mentors can help you avoid some of those things.
Yes, I'm an early stage entrepreneur, just started a company spinning out technology out of Vanderbilt. And I'm wondering, for early stage, like very early stage, what guidance can you give on getting into having the network of people to get your idea in front of the right people? It seems like there's kind of an initial barrier, just like how do you get in touch with venture capitalists? How do you get your idea out into the places where you can start getting critical feedback and getting the things that you need to get off the ground?
That's a really good question. It's probably one I should have touched on. I mean, I do think that you benefit from having a warm introduction to a potential source of capital, because one of the problems, going back to my you know, I have more money than time problem, is that if you're a venture capitalist, you get inundated with ideas and opportunities. My old boss used to say, you know, what we do is like finding a needle in a stack of needles. And everything looks the same. Oh, you know, and some of those things will poke you, and some of them are actually bright and shiny, and you don't know which one is which. And so what I would do would be to work very hard to, you know, talk to your friends, talk to colleagues in the business, talk to other people that have raised capital in the past, and get them to introduce you in a way that you'll be noticed. Because if you come in with somebody that vouches for your credibility, you'll be better off for having done that. You'll be much more likely to get the right group's attention, and you'll be much more likely to succeed in your fundraising process. So, one more? Or yeah. Okay.
Hi, I'm an undergraduate student. For my senior design project, we're working on something that is, like you said, very cheap, pretty easy to make. It's already happening at Vanderbilt. But how do you quantify that IP, that intellectual property? How do you explain that that is actually worth something to someone when in reality we've spent $6?
Well, I think you might not be able to convince them. That's one thing. And you might have to fund the advancement of your project to a point where it's a little bit further along in order to have the credibility to convince somebody that, hey, this is an interesting thing, and you can fund it with your own sweat equity. You can fund it with money. But the further along you go before you have to raise outside capital, the more of your business you will own. And so I would say, generally speaking, when you have an idea, you should probably develop it. And you should probably develop that idea in a way that it becomes more of a coherent business model and less of a pie in the, you know, kind of less of a pie in the sky thing and more of a real thing that you can present this real thing to somebody than, oh, I've got an idea thing, and you'll be better off for that. And there's a, you know, there are a lot of businesses out there that were formed and got up and running and operate and have a product that's very inexpensive to make and very valuable to people. And that must mean it's hard to duplicate, because if it was very inexpensive to make and it was very valuable, all kinds of people that could duplicate it easily would try and duplicate it and would drive down the price, and it would be less valuable as a function of that. And so you have to consider a lot of those things. But I would say in general my advice would be try and take a thing further along before you seek outside capital. Use your own resources, use your friends and family, and use your sweat equity to do that. So,
Let's thank Bruce.
thanks everybody.